All right, market heroes, welcome back. We're talking about market awareness right now. And this is a really, really important section. I'm going to do a little bit of a chat right now, and then I'm going to get into actually what I do in terms of market awareness. So, the first thing is those who are engaged, the more engaged people are in the market, the better they do. So in Market Hero, we definitely have. Hold on, let me turn this down a little bit. We definitely have um, sections that are just very rinse and repeat trades, right? Strangles, straddles, whatever it is. We know the right time to do them. Um, we know how to do them. We know how to manage them, et cetera, et cetera. We also have our shortcut trades, which again are designed to be incredibly profitable, market-beating trades that take, 1 day a week, 1 day a month, 1 day a quarter, 8 days a year, whatever they are. That's fine. You can make money and you can be a market hero and you can make $1 million in the next few years doing those strategies. You can definitely do that, no question. But if you really want to be a market hero, you really want to crush in the market, if you want to make the market your full-time gig, if you want to get out of your shitty job and you want to just be a trader for your life, market awareness is really, really key, and it's really, really important to really having big-time success in the stock market. Those who are more engaged and more aware of what's going on in the market are those that always, not typically, that always do better. They have more of an understanding of what's going on. If stocks go down 1%, they don't freak out because they've seen it before. They see those as opportunities as opposed to times to kind of like, run for the hills type thing. So the more engaged we are in the market, the more we're trading, the more we're learning, the more we're watching the courses in Market Here, the more we're engaging in our webinars and our Facebook group and our email chains and all that stuff. The more we're engaging in that, the better we're going to do. So when I think about market awareness, I think about a few things specifically. Number one is having an understanding of what is going on at a high level, right? So when I think about a high level, I usually am thinking about the futures, right? And if you could see at the top left portion of my screen right here, I have one of my watch lists on the Thinkorswim platform, and this is called Stevens Futures, right? So there are, let me see, 10 futures that I watch every single day. We have ESU, which is the S&P 500 futures. We have NQ, which are the NASDAQ futures. We have YM, which are the Dow futures. VX, which are the VIX futures. ZB, bond futures. GC, gold futures. SI, silver futures. CL, crude oil futures. NG, nat gas futures, and 6E, euro futures. We also used to have TF, which are the Russell 2000 futures, and DX, which are the dollar futures. However, TD Ameritrade stopped offering those, so we can't have them. But these are the 10 futures we watch every single day. So what I take away from those is the first thing is they trade 24/5 for the most part. So when Asia opens at 6 p.m. Eastern time on Sunday night, the futures are opening and they're trading. So if we have some geopolitical whatever the hell going on or something happens, you can actually get a good gauge of what's going on in the market in terms of the Asia investors and people who trade Asian hours just based off looking at the futures, right? So if you guys remember, after the US election, the futures were down. The S&P futures were down about 100, only to next day rally to go up to actually $20. So they went up 120 points from the night before to the end of the trading day, right? Some pretty amazing stuff, right? And it's important to watch because all the stocks on our watch list that we will get to here in a minute all correlate at some level to one of these futures contracts. Right? So if I look at Snapchat, that is a technology stock. For the most part, that's correlated to the NQ or NASDAQ. Apple, for example, is also a technology stock. Apple, for the most part, is correlated to NQ or the NASDAQ futures. Disney is part of the Dow. And again, I know this because I'm aware of this stuff. I'm engaged in this stuff. Disney is part of the Dow. So Disney is mostly correlated to The Dow futures. So if I'm thinking about making a trade in Disney, for example, the night before or the morning of, I can take a look at YM or the Dow futures and have a good understanding if Disney's going to open up or down. And then based off the strategy that I was interested in the day before, I might have a better opportunity to make a trade or a worse opportunity to make a trade, right? Same thing with XLK, for example. I know because I'm aware of the market that XLK is very much correlated to the Nasdaq, right? So if the Nasdaq has been up, right? So let's say the Nasdaq has been up like it has, and volatility is middle of the range, and I want to sell a strangle, for example, in XLK. That's what I'm looking to do, right? So in XLK, I'm looking to sell a strangle because I see that volatility is close to above its average. It was just down. So let's say, so today is Sunday, so I'm saying, okay, Monday, I would like to sell a strangle in XLK because volatility is high, right? It's around 44%. Volatility is high. Like, I want to sell a strangle because for whatever reason, right? So tonight at 6 o'clock, I could look at NQ and I could see what it's doing, right? If NQ is up, I know that volatility for XLK is probably going to go down, right? So it might not be the best time to put on that trade. However, if I wake up tomorrow morning at, let's say, 4 o'clock or 5 o'clock, and I see that NQ is down, for example, I know that XLK, hey, this is definitely a good time to put on that trade. Right, so it's just market awareness. Same thing with VXX. If I want to get long VXX, I can just look at the VIX futures to see what VXX is going to do as an example, right? And I can go on and on and on and on, right? So market awareness is so, so important. At the same time, you know, we always want to trade at our price, right? And one of the things that we look at is price movements going inside their expected move or outside of their expected move, right? So I don't really need to look at every single one of these stocks all day for that type of information. One of the things I can look at, as you guys know, are the futures, for example, right? So if I look at, let's say, the NASDAQ, right? Right now it has a 16% implied volatility. I know because I'm a market hero and I actually looked at the lessons from implied volatility that a 19.1% implied volatility means there's an expected 1% move per day, right? So now I'm saying, okay, it looks like on Friday it went down about as much as it's supposed to. So this move of down 0.86% in the NASDAQ is not really outside of its expected move. So maybe this is not a good time to start to look at long positions in NASDAQ related stocks, right? As an example. Let's look at one that went outside the expected move, right? Crude oil, for example, has a 38% implied volatility, right? A 19% is a 1% move on a given day. A 2% move would be a 38% implied volatility. Crude oil went outside the expected move by about half of a standard deviation, right? So the fact that crude oil was down 3.12%, now I'm going, okay, now this is interesting. This becomes interesting for me because I know that crude oil went outside of its daily expected move, right? Stocks are very cyclical. They ebb and flow. They go up and down. And the more they go up and down, the quicker and more likely they revert to the mean a lot of the time. So I can sit here on a Sunday and go, okay, definitely on Sunday, crude oil went outside of its expected move to the downside, right? Maybe there's a stock like USO that is tied to the price of crude oil that I can look to make a trade on to the upside because crude oil on Friday had a day where it moved very large outside of its expected move to the downside, right? So this is where market awareness comes into play in terms of futures, right? If we look at gold, for example, gold is expecting about a 1% expected move per day, and it only went up about 0, right? So it didn't go outside of its expected move. So I shouldn't really be looking for gold-related stocks like GLD, for example, to be placing trades where there is a big reversion to the mean trade, for example, right? So that's how these trades really come into play. Nat gas as another example, right? Nat gas has a 30 implied volatility, which means it has a 1.5% daily expected range, right? Nat gas almost went up 3%. So Nat gas went down about 3%, which is 2 times its expected move. I know because I'm aware that UNG is the ETF, right? Is the ETF for natural gas, and because natural gas had a 2 times its expected move to the downside, I should be looking for a move to the upside, right? And again, we see volatility is about mid-range. It's on the downside. We could do a long call debit spread. We can sell a put spread. We could sell a put. We could do a double long. So there are a lot of opportunities we can do here, and it's a great opportunity because we know on Friday, the last trading day, nat gas moved down about 2 times its expected to move, and we could see that, right? So those are kind of the futures, and then we go into my stock and ETF watch list, right? So these are all the stocks that I might ever trade. These are the most liquid products in the world, right? So you can see I have last, I have net chains, and I have IV percentile, right? So this is implied volatility percent. The first thing I do is I order these by IV percentile, because my best strategies, as you guys know, are from selling options, right? We sell options because options are overpriced. They're priced off their expected move. IV for percentile is just a way, and again, all of these tools are going to be available at the bottom of this lesson to download for you guys, but IV percentile is just a way to say if volatility is greater than its average. So anything over 50, right, on this from IBM up, is a great time to sell options because we know those options are more overpriced than they normally are. So we have a very large edge when it comes to that. So I'll go ahead and I'll look at some of these stocks and I'll see what we have, right? So let's say Verizon right now has an 86, Verizon has an 86 IV percentile, right? So it's at its 86 percentile. So this is well above its average, right? And I also see, based off another indicator, that over the last 10 trading days, it looks like Verizon's down over 5%. This is an excellent opportunity to get long. Now, as you guys know, because you are market heroes, some of the best trades for that are short puts, double longs, short put credit spreads, covered calls, option-only cover calls. Right? These are great moves because, again, we sell into strength and buy into weakness. All those opportunities are bullish strategies into weakness. And we know that the implied volatility is greater than its average. And we know that we are buying into weakness here. That's how I do it. And I kind of go down everything. So let's say I go to Apple right now. Apple has a 65% implied volatility. Over the last 10 days, it's gone down about 3.3%. This is neutral for me, right? So I don't really have a directional bias. All I know is that options right now in Apple are more overpriced than they normally are. So now I'm looking for strangles, straddles, iron condors, heavy iron condors, or a lot of those types of trades, right? And then let's do another one real quick. So let's look at Disney, for example, right? So Disney, just looking at this graph, has an implied volatility about 55%. Right, so greater than average. So this is a great time to sell options because we know they're extra overpriced than they normally are. And based off this indicator right here, which again you guys will get for free, it's right down here under this video, which you guys will get. It looks like it had a big sell-off on Thursday, then didn't really do much on Friday. So over the last 10 trading days, it's down almost 6%. This is an excellent time to get long, have a long directional bias in Disney via selling options. So again, short puts, short put spreads, put credit spreads, long options only covered calls, etc., etc. Because again, I'm seeing that volatility is high and it's on the lower end of its range. So after I've gone through those that are high volatility, I go through those that are low volatility, right? So I see X has a 0 implied volatility, right? So X is kind of mid-range, right? Kind of mid-range, and it has a 0 volatility. If I am a believer that X might go up, US Steel, one of the trades I can do that is, again, low volatility, low end of the range with a directional bullish is a long put debit spread, as an example, right? A long call debit spread that profits from either prices going up or implied volatility going up. Remember, implied volatility is mean reverting. Right now, the volatility here is an absolute 0. I'll look at that for a couple others. Let's say GM, right? So GM is at the high end of its range and volatility is at its lowest, right? And if you remember, over the last 10 days, GM went up about 4.2%. If you remember in our long put spread, in our long put debit spread lesson, we talked about it's really only profitable after it's gone up or it's extended to the upside and volatility is really, really low. This is a perfect example of that. So this is how I use that. So again, I have my futures watch list where I'm looking at the daily expected moves. And if something is outside of that expected move, I'll go ahead and see if there's a counter trend trade I can do based off of implied volatility. And then I'll look at all my stocks. And I'll start from the highest volatility. And then depending on where they are, high end of the range, mid end of the range, low end of the range, I'll make a trade where we're looking to sell options because we have a huge edge. And then I'll look at the complete opposite. So those are the very low end in terms of the volatility range. And then depending on where they are, low end of the range, high end of the range, middle end of the range, I'll make a decision to probably have some sort of a debit spread or a calendar spread or a diagonal spread. So again, market awareness, super, super important. This is how the money is made every single day. I'll see you guys in the next video.